Welcome, everyone, to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe. And for those of you that do, I'm sorry. No, seriously, thanks for checking me out again. Except for you, J-Rod, get fucked. This is going to be a quick preview ahead of the FOMC's biggest and most important FOMC decision ever. I'm being facetious there, but it is important, right? So this is going to be a quick video, hopefully, about what it is that we're expecting going into it, what it is that has happened. I know it's been a while, and what it is that I'm looking at moving forward. And then, when the pivot bros get their pivot. When pivot, y'all. This is intended for informational and educational purposes only. It's not financial advice. I'm just some random dude on the internet. I'm not your financial advisor. Talk to somebody if you want a financial plan, especially in this market. This shit's crazy. And build one out that works for you. I'm not the guy that you should talk to about that. You should talk to someone who would know better than I do. So please talk to someone, get some help, get it all sorted out. I'm going to jump right into it, and I'm going to try to make this one really quick. The first thing I want to do is go over the past, right? So I'm going to bring up an old slide. I'm sure you've seen this if you watched my videos before, but this is reference back to Jerome Powell and the Jackson Hole meeting. And the reason I want to bring up this little brief history lesson is because I think it's important for us to know where we were ahead of, the pivot, quote unquote, in hope to reality, and where we are today. See if anything's changed, see if anything's still in line or if things are different, and if we can kind of like map it out, right? So first things first, in the Jackson Hole meeting, it was a little bit different than the other, FOMC meetings in particular, because there's no Q&A, right? So it was kind of, you got this really weird moment where people kind of got together and waited to hear what it was they had to say from Jackson Hole. A lot of people thought it was going to be like a non-event. There was a lot of hope, if you remember, back from that time. We'd had an 18% rally in the NASDAQ, 20% somewhere around, or 18% in the market, about 24% in the NASDAQ, ahead of Jackson Hole. And the primary focus there was just that people kind of thought that the Fed was kind of bluffing, or that the economy would right itself. But in that moment, we had J. Powell came out and really kind of was the first moment that he really hit the hammer and was just like, hey, no, this is for real, right? So the first comment that we went over is on your screen. Federal Open Market Committee's FOMC's overarching focus is now to bring inflation back down to our 2% goal. So that was the first thing. It's important. Let's make a note of this 2% goal that we're talking about here, right? Next thing, restoring price stability will take some time and requires using our tools forcefully to bring down demand and supply into better balance. Emphasis here, keep that in your mind too, because we still have this problem as well. Keep going. Reducing inflation is likely to require a sustained period of below trend growth. Moreover, there will very likely be some softening of labor market conditions. I want to stop here for a second because we don't have any softening labor market conditions. We just got our JOLTS number today. If you paid attention to the stock market today, we had this quick reversal. Started at around 10 a.m. Started with the JOLTS number, right? And that's just job openings. Job openings were greater than what they were looking for. And essentially that means that there's still, a tight labor market. People still don't want jobs. People still don't want to work. People still have jobs, right? There's not an unemployment thing, and there's not a tightening in labor markets conditions. In this instance, and in instances prior, Jerome Powell specifically mentioned job openings, and in this case in particular, he mentioned the number 2 for 1, right? So there were 2 openings per 1 applicant at the time when he spoke, and when he spoke in the last meeting as well. So let's keep it going, right? So while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring down some pain to households and businesses. None of that has happened, right? The only thing that we've gotten out of that is higher interest rates. Essentially, the U.S. consumer is still strong, still spending. People still have jobs, and inflation hasn't come down, right? We got our last CPI report, and it hasn't come down. It hasn't materially softened in any way, shape, or form. And what it was that Jerome Powell was looking for never really happened. So that's TBD in that sense. Let's keep it pushing. So the last point from that slide that I think is important to bring up is the historical record cautions strongly against prematurely loosening policy. So a lot of people kind of make reference to Volcker and make reference to the Fed and make reference to what it is the Fed's going to attempt to achieve and how they're going to attempt to achieve it, right? And so one of the main things that people say is a pivot's coming, and the reason that it's coming is because, I honestly I don't have a case for why it's coming other than people's stocks are going down. But one thing that the Fed has been kind of steadfast about is that they need to be cautious and they need to just kind of hammer it down. Now, you and I can argue about whether or not what they're doing is actually going to make a difference, right? I tend to think we have a structural inflation issue in addition to a potential demand issue. I think the demand side is going to abate itself, like consumers going to run out of money, some people are going to get fired, yada, yada, yada. And we kind of went from people wanting to buy stuff to doing stuff this year anyways. So people in general were already going into an economic change, if you will. So we can argue about that part, right? But the important part, I think, is that there is a structural problem with, inflation in general, whether it be like a lack of housing inventory, or whether it be the price of oil is not something that we can kind of control, or whether it be the price of food is not something that we can potentially control because of just making our own food in excess. Whatever the case may be, like there are structural issues that are going to kind of put a knot into the inflation rope, if you will, if I use some shitty metaphor there. It's pretty much a given at this point that the Fed is going to raise by 75 basis points. That's the expectation. And if you just take a look at their watch tool, or if you take a look at any website, CNBC, whatever, here's your expectations, right? So you've got, I'm going to go to another one here in a second, but you've got essentially 75 basis points this time. And then, there's a 50-50 of whether or not it's going to be 75 or 50 moving forward, et cetera, et cetera. The important thing here, I think, for all you pivot bros, when we were talking about this in September, the pivot was here, right? People expected that there would be a pivot somewhere around March, end of February into March. The second thing was that this was not a 5-handle. This was not a 5-handle. It's now a 5-handle. So sure, there could be potential that we get some sort of pivot at some point in the middle of next year. I think a lot of people are kind of starting to subscribe to that notion. But it's important to note two things. One, it kind of got pushed back a little bit. And then two, we're at 5. Okay, that's real damage to a lot of things across the board. The third thing, which is like an anecdotal thing, if people are wrong and we don't actually start to pivot here and we don't start to see some softening, because a lot of models have started to soften in the back half and started to assume that we're going to get some sort of 40 basis points reduction into 24. If you don't start to see that and you start to see higher for longer, it's going to cause a lot of pain with a lot of the sensitivity things. Okay, so you might have saw me accidentally click on a document here, but let's just kind of go over it real quick. So the first thing I want to bring up is when I'm piecing together this information about what it is that I'm going to kind of bring up or talk to subscribers about, I kind of try to get a picture of what it is that I want to say, right? So one thing that I think is kind of important to note is that the Fed likes to do this thing where they talk rates one way or the other to potentially kind of give people a situation where they can kind of guide the narrative, right? So part of the pivot talk that we're seeing right now comes from the perspective that just ahead of the blackout window for the Fed, they started to kind of talk things down a little bit, right? So they started to soften their language. And if you kind of just overlay, and we'll get to this in a second, but when you overlay the market's chart, these things tend to happen at inflection points when things run rampant to the upside and things kind of get accelerate to the downside as well. So this basically says, while the Fed is committed to do whatever it takes to bring down inflation, it should be noted that the tone deployed by a few FOMC members began to soften just ahead of the blackout window, leading to rampant speculation of when a pivot may arrive. Nevertheless, the hotter than expected September U.S. Inflation report, CPI, and stronger or strong September U.S. non-farm payrolls report suggests that an aggressive policy tightening efforts will continue in 2022. So I went through and kind of pieced together, from September, Bostic. You can read these. I'm going to go slowly here, so you can kind of pause and read some of the comments that were said. Right. So this is kind of like a timeline from late September to the blackout period. Right. So and I'm going to slowly get to the end here, and when I do, I'm going to pause it because I want to let me edit this. I want to really kind of drive home a single point here. So forgive me, I'm a little OCD about some of this stuff. All right, so let's just get to the end. Come on. And again, if you want to read this, you can pause it and go through it. I think it's worth the read, and kind of gives you a timeline of how things change and how aggressive they get. And the point that I'm going to highlight is right here. So October 20th. And for this one, fuck Philly. I know you guys probably won your World Series game, but baseball's not a sport, but fuck Philly. So Harker, which is the Philadelphia president of the Fed, commented that given our frankly disappointing lack of progress on curtailing inflation, I expect we will be above 4% by the end of the year. If you go back to this date, this really kind of flipped the script for stocks on the 20th of October. Not a day removed, Daly said it's not yet time to step down the pace of rate hikes, although it should at least be something we're considering at this point. But the data haven't been cooperating. So this was right at the cusp of the blackout period, right? So that's the whole point I'm getting at here, not to be a dead horse or anything like that, but essentially October 20th was the end of the Fed basically being aggressive with their language, but on the 21st, there was a little bit of language suggesting that maybe they can be a little bit more measured, right? So what does this all necessarily mean, right? So let's just go real quick. These are the meeting probabilities, and this kind of tells you that we're at 80. This is basically 100. When I did it, it was 88%. But basically, you're at 100 for 75 tomorrow. So, what does that mean? Does it mean that if they come in tomorrow and it's 100 basis points, people are going to panic? Probably. If they come in 50 basis points, are people going to then believe that things are better? Possibly, right? But essentially, the expectation is for 75 tomorrow. And then on the next one, you could start to argue about whether or not it's going to be 50 or 75. So you basically got a 50-50 for the next one. So when we have that kind of play out, we get 75 basis points, then what, right? If we get 75 basis points, if I told you 75 basis points was on the table for every Fed meeting after the first 75 basis point hike earlier in the year, you'd say we would probably lost 50% by now. But we keep getting these back and fills and sloshing around. So instead of doing that, let's just look at data, right? And so when we take a look at the data, this is courtesy of Canaccord Genuity and I believe Ned Davis, but Canaccord Genuity for sure. Shout out to them for putting together some of this data. But this year's S&P 500 fall of more than 20% through September, and we were at 24.77%, represents the third worst first 9-month start of the year since it became a 500 stock index. So if you just go back to when we had S&P become 500 stock index, we had the third worst start in the first 3 quarters that we've ever had on record. And when you take a look at the history, it tells you that in the 5 prior instances, there was a median return in the fourth quarter of 7.92% to the upside. So if we just take a look at this, all this data, this is us right here. We were down 25% basically in the first 9 months. And historically speaking, if we take a look at how things performed in every other instance outside of 2008, you essentially get a 7.92% return median, right? And this is in the fourth quarter. So that's good, right? So essentially a good thing that we get stocks to rally. Well, not so fast. If we kind of put that information with a little bit of color, we can kind of understand what it is that we could possibly expect, and that there could be a little bit of upside. But the bad news is that that upside could be muted once it gets to a certain point because people are starting to position for it. And it doesn't mean that the actual low is in. And so to kind of get a better sense of this, I think that it is important to just kind of take a look at where we are, right? So this is the S&P 500. I didn't do anything to it. I can hide all of these if y'all want. Let's just remove all indicators. Here's the S&P 500. I didn't do anything to it. I didn't put any lines on it. I didn't do anything, right? So let's just go back and add everything again. And here are the rallies in the S&P, into last year and then this year, right? So it depends on how you want to look at it. But if you just take a look at peak to trough from this time last year, sure, let's just take a look at it into the end of the year, right, or into the beginning of this year, right? You had a 13% rally followed by a sell-off. Then we have Russia, Ukraine, Fed is going to be hawkish, and things fall apart. We get another 13% rally into a downtrend. And then, the Fed's aggressive, sell back off. Aggressive sell off, and then find a floor. In June, we had this optimism, 19% rally, sell back off. And here we are again with another 12% rally. So if I go back and I tell you that historically you get an average of 7.92%, a median of 7.92% return, and then I tell you that even with today's selling, you are up 10% into the Fed meeting, ahead of whatever decision that they're going to make on the back of a high CPI and a really strong labor market and pesky inflation. It doesn't really give you that much confidence, right? So, but like ostensibly, let's say that they continue to rally it, and you get this run up in stocks, and the market itself continues to rip or whatever. What is it that we can potentially expect? So, generally speaking, when things, the way that I've traded this year and that we've traded this year is when you get things that are aggressive to the downside and to the upside, kind of take a step back, right? So if things get too aggressive to the upside, I lean into it short, using options. And then when things get too aggressive to the downside, I kind of take a pause and step back. Now, if it were to run up another 18%, it would just basically put us in a situation similar to the one we had in the summer. There are people that subscribe that the Fed's going to be apolitical and kind of like just kind of like punt on this Fed meeting in hopes that they don't particularly interfere with the election. I'm not one of those people. I don't think that's reasonable, but I could be wrong. But that said, should they come out and be aggressive and kind of like hold the line, we set ourselves back up for another downfall, right? So it's important to kind of know these things. If we just take a look at the weekly, for example, as well, the S&P is bumping up against its 20-week moving average as well. So you can believe in moving averages, you can not believe in moving averages. It's up to you. I don't care. But there's a lot of people that do, so it's important to kind of keep this stuff at the back of your mind. So that's one thing. The second thing that I want to kind of touch on before I go into the third thing, which I think is really interesting. So the second thing is, this is from the beginning of the month. Now, this one I know is from Ned Davis, but S&P 500 versus top 10 S&P stocks by market cap as a percent of total S&P market cap. So this is a representation of the top 10 stocks, this bottom panel, representation of the top 10 stocks of the S&P. if you just take a look at where things are currently, right here, we've gotten to a point where it's like, where's the number? It's 29.6% of the S&P, top 10 stocks. Now, in this recent sell-off with Facebook, Amazon, Google, all that stuff, this number shrank. I think it shrank down to 26% just in that short period of time. But it's still like historically elevated. It's higher than .com, all right? And you have to go back to 1975 to see this kind of work its way through. And essentially, this is a situation of knowing that there is a potential that you see these stocks that make up the top 10% of or make up the top 30% of the S&P, kind of give back some of the returns that they've had and kind of shrink, while other stocks under the surface kind of expand, right? So this is an instance where you could see the Googles, Microsofts, Apples, Teslas, etc. of the world shrink, go down, while you see some of these undervalued stocks that have been, beaten up all year, start to perform. And you could also see a situation where you have some of the names that have outperformed in the back half of this year, whether it's healthcare, whether it's and they're rate sensitive names, right? So whether it's healthcare, whether it's some of these energy names, some names like that, you can start to see some signs of leadership change in the market, and that not really reflect in the index itself as much as it would reflect if it were Apple or Amazon or whatever, because they don't make up a lot of the index, right? So if you go to the fourth quarter, remember the one outlier I said was 2008. So I think it would behoove us to say that and then not kind of examine what it was that happened in 2008, right? So in 2008, it is, if I go one more time, just let's go back here. 2008, markets were down 22.5% in the fourth quarter. Now, if we go to 2008, 2008 is a lot of people's favorite analog to the market conditions that we're having right now. And if we were to use 2008 as an analog, it was, the Lehman crisis and the bailout and the Fed emergency rate cut and all that stuff. And then there was an election. So there's a lot of things that are kind of in line. There's a dude, I don't remember his name, but something Kramer. He loves to throw up these like 2008 fiasco analog charts and kind of show you how big of a fiasco things were in 2008 and where we are along, and we're almost there, right? We're 12 days off, right? He does that thing, but I'll leave that to him. But the important part here is, if you've heard me talk, essentially what we want to see is we want to see the 2-year and or the 10-year start to fade, the 2-year yields, and then after we see that, see a fresh bottom or a fresh new low in the markets with that 2-year yield not return to highs, right? So we want to see the 2-year top first, new market low, and then that's kind of like our bottom. And what's important about it, and why I like to look at the past and kind of do this, is that if you just take a look at 2008, for example, you had a lot of sloshing back and forth, right? And that number that I gave you, which was a minus 23%, call it, came even though you had a 21% rally or 22% rally in the markets for the month of December, right? So there are situations where you can see massive sell-offs and then correct back up. And then simultaneously, there are instances in which we can see, rallies, and then things get extended. And on the back of things getting extended, we start to see, fades, right? So there are instances where you see rallies like this, and then we start to see fades. And then there are instances like the one that I am sharing in front of you, where, the market sells off more aggressively than 23%, but then recovers some to end the year because at some point people start to price in the next thing. The last thing I want to point out is the VIX, right? So the VIX is kind of like at an interesting spot because we are sitting right on support on the VIX, right? I cleared it so that I can share the chart without having any bias. But if you just go back out, essentially this level, this like 34 plus level in the last year, 2 years, outside of COVID, was where we would start to see some sort of a pause in the VIX, and then simultaneously or secondarily, we start to see a support at these major moving averages we have, at least recently. So could be setting up for an instance where we have this like Fed that stays more aggressive than people want, and start to see a sell off. And then as we work through some of these situations in the macro picture, if you will, if you like the election and CPI print and all that stuff, and into the end of the year, could see some sort of relief, or the other way around, right? So it's really important to kind of do that. I'm running about 27 minutes now, so let's just call it quits here. It's been a while, right? So let's just I'll try to stay on it a little bit more. I kind of don't like to do them if I don't really feel like I'm adding any sort of value. But here we are. Hopefully I've added some value. If you've got any questions, comments, concerns, please let me know. Thanks for watching. Please hit the subscribe button if you haven't. Share it if you liked it. And as always, thank you for watching. Please stay safe, stay profitable, and stay locked in.